News is out. Elon Musk to acquire Twitter. It will become a private company. It's going to be Twitter's to be acquired by an entity wholly owned by Elon Musk for $54.24. And 20 cents per share in cash. An evaluation valued at approximately $44 billion. This is the amount that was originally proposed by Musk. So worth noting that as he had originally said, he was not open to negotiation there.
Laundering is really quite ferocious. It's when a huckster takes some lies and makes them sound precocious by saying them in Congress or a mainstream outlet. So disinformation's origins are slightly less atrocious. It's how you hide a little lie. It's how you hide a little lie. It's how you hide a little lie. When Rudy Giuliani shared bad intel from Ukraine, or when TikTok influencers say COVID can cause pain. They're laundering disinfo, and we really should take note and not support their lies with our wallet, voice, or vote. Oh, information laundering is
no, God!
It's when a huckster takes some lies and
no,
makes them sound
God,
precocious
please,
by
no,
saying them in
no,
Congress or a mainstream
no,
outlet. So disinformation.
no.
Wow. What is going on, everybody? Happy Sunday. Hope you've had a great weekend. And I hope you've had a great couple days away from the bears that have taken over this market and from the bloodbath that ensued towards the end of the week last week and to close off the month of April. So take a seat, kick back, grab a drink, put your feet up, and let's get right into it. First thing, I'm not going to go on a long tangent about that opening clip, guys. And I don't love Elon for everything that he does, but I am a proponent of him taking over Twitter and fighting for free speech. There's too many platforms over the years that have gotten more aggressive about censoring things, taking things down, and making creators hesitant to speak their mind, to say the things that they want to because of the fear of, for example, YouTube demonetizing their videos or pulling information down on other platforms like Facebook and Twitter, etc. So I'm really curious to see how this pans out with Elon and what he actually does in the Twitterverse to, basically protect our freedoms of speech. Let's start with the first headline. U.S. GDP fell at 1.4% to start the year as pandemic recovery takes a hit. And then there's a quote at the bottom. "This is noise, not signal. The economy is not falling into recession," wrote Ian Shepherdson. What a dip. Every time we get a bad reading or a historic high reading for the last 3 or 4 decades, for example, inflation, we had a high reading and all of a sudden it's peak inflation, it's all over, and now we're getting a contracting GDP, and now, wait, it's not a recession, it's just noise. Don't listen to these Follow the data points, guys. It's telling you everything you need to know. On Friday, we got the personal consumption expenditures data. This is one of the Fed's favorite indicators for inflation, and a few things to note on here. Durable goods are starting to drop, so that shows signs of a weaker economy when people are buying less of these durable goods. Non-durable goods are starting to go up, so these are things more that people need, necessities that are consumed more immediately. You can see on the food side, 2 months of successive 1.4 increases. On the energy goods and services side, we had another bump up in March, which was a historic high, it looks like. I don't have data going back further enough, but 11.8%. And I just wanted to compare it to February and March of the prior year, so you can see they're both kind of higher data point seasonality. But if you go down to the graph below that shows the energy goods and services section of that specifically, there is no sign of stopping this. So I don't think we've seen the end of food or fuel inflation at all. And we may not see that for, another quarter or two, possibly by the fall. I'm not predicting these things, but again, it's going to take a long time for this to come to fruition if the Fed actually starts doing the things that they said they're going to do. And one more thing as a side note, this chart is the personal savings rates. Savings have dropped to levels we haven't seen since 2013. So to say the consumer is doing well, it sure looks like they have spent all their stimmy money. And then we've also seen data points where you have consumer credit has started to just skyrocket. So people are putting money on credit cards and they're running out of savings. This just has recipe for disaster in the long run, especially if rates start to go up. Those credit card percentages are going to start increasing and people are going to run into a lot of pain. Let's talk some earnings, starting with Microsoft. Earnings beat across the board, stock up on outlook. Beat expectations on top and bottom lines. They had good guidance, and they're still looking to acquire Activision. So there is some positivity out there. Apple had some good earnings. Revenue grew 9% year over year, but they did warn of possible $8 billion hit from supposed supply constraint issues. Now, we just talked about the consumers running out of money. Maybe they're not spending as much on Apple products in the future, and now we're using the excuses of supply constraints or Russia-Ukraine problems going on. I think the only thing that really helped keep it up was a $90 billion share buyback. An insane amount of money. That's twice what Elon paid for Twitter alone. So they clearly have enough cash to help pad the pockets of the executives, and it's just a big, massive Ponzi scheme, in my opinion. And then we have Amazon. Yikes. Took one right to the groin. So the company reported a loss of $3.84 billion or $7.56 share for the first quarter. In the first quarter of last year, Amazon reported a profit of $8.1 billion or $15.79 a share. That's a massive drop. The company said Thursday it projects revenue between $116 and $121 billion, which is below average estimates of $125.5 billion. Also, Amazon reported a $7.6 billion loss on its investment in electric vehicle maker Rivian. So it's pretty cool thinking you're a bag holder of Amazon and you're indirectly a bag holder of Rivian. So now you're double losing. That's a pretty awesome thought, right? They said companies focus on improving productivity and cost efficiencies, but that will take time as Amazon continues to address inflationary and supply chain pressures. I definitely would say good luck with that moving forward. I don't think the consumer is strong enough, and I don't think Amazon is going to pull back from this. All right, so let's get into some technicals. So let's review the risk ranges from last week on a few stocks. I'm not going to go over everything that had earnings, but let's cover a few of the majors. So first up, UPS. I got all their risk ranges that are noted in here. And again, the blue lines are going to be your upper and lower ranges. So UPS gap down on earnings, stayed well within this range, guys. And again, remember that 68% of the time we close within these ranges. So keep that in mind as we're moving through all this. Microsoft, the one that had pretty decent earnings, gapped up on earnings, pressed up towards that upper risk range, didn't quite get to it. It came within, a couple bucks. Pulled back, tried to reach it up again, and sold off under the pressure on Friday. But again, if you're an intraday trader, these give you great opportunities to short, to maybe go long. Just it kind of depends on what your preference and what your style of trading is. I'm not a big intraday trader, so I would more rather play these off of swing trades. So if you get up high and you can short it for a day, or if it gets down to the bottom, you can buy it for a day. It just kind of depends on what the market's doing overall and what that stock is doing. Google, Alphabet, again, gap down, fluttered around, tried to fill that gap, which it did, and then it kind of dropped back off on Friday. Again, we're within the range. Chipotle, CMG, almost smack dab in the middle of the range. Again, it went nowhere. Facebook, we didn't talk about earnings on this one, but it had better than expected earnings. So you can see it gapped up to around that 208 level, which our upper range is 209, and it dropped down all the way to 192. So if you're a short trader, an intraday trader, you can get 16 points off of that, which is a nice short trade. Again, I don't trade that way, but you can see it push back up towards that upper range, tried to break above, fell back below, and naturally it held within this range once again. Apple gapped up, pressed up, didn't come anywhere near its ranges once again. Amazon, this is one of the anomalies, right? Because Amazon had terrible earnings. So you can see it gap down below. So this is your lower risk range, or your first deviation. This is your upper. And so because it gapped below on a Friday, it creates more pressure to the downside. So is this part of the reason why the market's sold off on Friday overall? Maybe. But again, so this dashed line is going to be your second deviation. So just another movement of this price range to the bottom. So another 214 down from your first deviation. So again, you can see drop down below it just a little bit and kind of recovered just above it, above that second deviation. But so this is one of the rarities where 27% of the time we close outside of that first deviation and within the first and second. Roku was another one. They actually gapped this up. They dumped it on earnings in the after hours down to about 75. So they broke it below this level to around here and recovered it all by the open of the next day. So there's room to trade these in the after hours too. Again, that's not my style. It's too volatile. But again, so out of all these 8 stocks, one closed outside of its risk range. So again, those probabilities are on your side. Let's look at the risk ranges for the indices themselves. So on the top portion, we've got the SPY, QQQ, IWM, and below it we have its relative continuing contract of the futures. So the S&P spiders, was within its range most of the day and closed down right on the bottom side of its lower risk range at the end of the day Friday. The Qs, very similar pattern, didn't quite reach the lower side of its range. IWM, you can see came down here, bounced off of it Thursday. You got a nice 7-point run up off of that lower range. So again, if you're an intraday trader or a swing trader on the short term, you can catch these bounces and get a nice run up. And then it obviously closed on the lower side of its range end of day Friday. ES futures. So this is overnight sessions you don't see on the spiders. Came down close to this, looks like between Tuesday, Wednesday. Came back up near the mid-range, and again, we got that pressure into the close on Friday, which closed on the lower risk range. The NQs, so the NASDAQ futures, nice, almost perfect bounce off of this range, well within 5-10 points, and you got a nice run up. So again, it just shows you how these ranges act as support points and good risk-reward long opportunities. Russell 2000 futures, very similar to the ETF above. But again, you can see it drop below Thursday, Friday in the morning. Got a nice ramp up. I mean, that's a huge swing here from the low, 1857, all the way up to 1925. So, I mean, 60, 70 handles just in a matter of a short time frame. That's a nice run up. But again, under the pressure on Friday, it dropped back down, closed at the lows. So again, just to review, it shows you how these risk ranges play out, how they act as support and resistance. So I'm just kind of trying to back test and show you guys why they are important. And in summary for these ranges, so many indicators are lagging. There's tens of, maybe 100, I don't know. There's a lot of them out there, but the one thing that we have that's forward-looking is options. And that's why I am trying to focus on these a little bit more. It's still relatively new to me, but I'm trying to just continue to focus on these and see how they pan out over time. Being that we're at the end of April, I thought it'd be important to go over some monthly charts. First, let's start off with some Forex and some bonds. So this is the US dollar, Japanese yen. Again, we've talked about this potential inverted head and shoulders, right? This is your left shoulder, head, right shoulder. It broke out of this range here. And so there's a few ways this could play out. This 124. It could very well continue its way up. Or it could, at some point, maybe it bumps up a little bit, pulls back, which should essentially give the dollar some relief, weaken the dollar, which would be good for equities before it continues its move up. Or we could have to be open to it maybe having a failed breakout and back down. But the fundamentals here are the Bank of Japan are continuing to ease. We talked about that. And our Fed is on schedule for a big tightening process here, whether it's interest rates and a reducing of the balance sheet. So I'm more under the assumption that this is going to continue up, giving the dollar strength. Now let's look at the euro US dollar. So we talked about this trend line that went all the way back to 1985 that it's recently just broken down out of. But you can notice that it's at a support line here. And so it's at an interesting level. And again, it really is going to depend on, what the ECB is going to do. Does it drop lower and then retrace before it continues down? Or is it going to retrace first and then drop down? I mean, you just got to be open-minded to this. Not that we're all trading this, but it just gives you a better idea of what can happen to the dollar. And if the dollar does get some weakness, that's obviously going to be good for commodities, gold especially, and possibly U.S. equities, because the equity market does not like a stronger dollar, especially for companies that do a lot of overseas business. But if this does continue down, again, that's going to weaken the euro and strengthen the dollar inherently. So we've covered the yen, we've covered the euro. Let's look at the dollar index itself. So we've talked about the 103 mark numerous times, and you can see through April, we had a nice run up into that 103 area, right? So now we're at resistance, technically. You've got a whole bunch of resistance here historically at that 103 mark. So given the fundamentals of the euro, of the yen, is this thing going to break out? For example, does it bump up to 107 before we get a pullback and then it continues to rally? Or is it a failed breakout? Does it come back down in here and fail to break out? But we still have this cup and handle formation possibly. So if this plays out, this thing could run up quite significantly. I don't have the measured move here, but I would say 130, 135-ish, something like that. So what the dollar does is going to affect the equity markets. So the equity market does not like a strong dollar, especially for the stocks or the companies that do a lot of business overseas, because when our dollar is stronger, our products, our services are more expensive, so other countries are less likely to be purchasing those from us. So it really will depend on what the dollar does and where the equity markets could potentially go. If we see this breakout, I would still expect to see some pressure in the equity markets. So maybe post-Fed this week ahead of us, we get a spike in the dollar with some reprieve, or it could very well happen that they start their schedule and lay out a plan for how they're going to unwind the balance sheet and raise interest rates. We just don't know yet. We should get some clarity on that on Wednesday. So given that, 103 is still very important. 107 would kind of be your next resistance line up to possibly, there's some wishy-washy areas in this 115 all the way up to 120. Keep an eye on it. It will be important to the equity markets. So let's look at a basic view of bonds. I'm not going to get super deep into all of the different variations of treasuries and all that, but I wanted to focus on the TLT. So this is the 20-plus year Treasury bond ETF. So back in 08-09, during the financial crisis, you can see this is when the Fed started their quantitative easing cycle at massive proportions, and it's gotten bigger and bigger as we've gone through the years. But what you can note is it's got this upward trending range that it's been trading in, which has been fairly consistent, right? So this upper trend line, there's resistance all across the board. And eventually, we got a breakout here. But I would call this an exhaustion breakout. because you can see what happened. It finally broke out all the way up to 179.70, and that's when, the thing happened and they printed a whole bunch of money and gave out stimmy checks to everybody. And then it kind of came back in here. So when you get these breakouts and these failures to hold, they fall down in a much larger way. And that's what you're seeing right now. And what's happened is there's a potential head and shoulders that's playing out in the moment. So we broke down even out of the bottom side of this range where we had previous resistances, right? It didn't even try to hold at all. And that's likely because of what the Fed is talking about doing. And obviously, again, if they actually do it, this may continue on. So the challenge here is, if this is a head and shoulders, this is your neckline. The measured move is down to around this 89.90 level. And what interests me about that is you can see back over here, this was normal activity in my mind. This is a normal range for a treasury bond ETF. The question is are we going to revert back to that mean? Look at this volume down here. This is big volume on the TLT ETF. The MACD is rolling down. The RSI is getting close to oversold, but do we get a reprieve here at some point? Do we get a retrace back up to prove this trend line as resistance before it continues down? I don't know. This is making it really difficult to have a safe haven. Now, when you think of the dollar strength, that would tell me cash is a legitimate position. If everything is selling off, if everything is technically in bubble territory, there's going to be nowhere to hide. Again, I'm not predicting that, but I'm just saying there is that possibility with what the Fed is planning, right? So be careful trying to find safe havens. I'm sure at some point this will go up, but I just don't trust this at all. Again, we had this failure to break out back into the channel, and now we're even back below. That is not a good sign overall for the bond market, at least in the longer ranging treasuries. On to the indexes. So monthly time frames for each of the indexes we'll go over briefly. This is the Spiders monthly chart going back to 0809. We've got this broadening wedge pattern that was broken out back in late 2020 that has yet to be back tested. What it's looking like, clearly the April candle is a bearish engulfing, very ugly, but you can see the volume isn't really indicative of capitulation or anything on a larger time frame yet. So I'm more under the possibility of a bounce coming up. I really like the idea of possibly breaking below that 400 mark before we get a bounce. That would likely trigger a bunch of sell stops, get some weak, inexperienced shorts back into the game, and then the smart people will start to cover and force it higher, which will again create this bear market rally essentially. Now what I'm thinking is playing out here possibly, and this is more apparent on the shorter time frames, but I wanted to focus on the monthly. This is what they would call an ABC pattern. So A is your down leg, B is your up leg, and C is an equivalent leg down to A. So it lines up nicely with this trend line that's been resistance over time, and we finally broke out here late 2020, which has yet to be back tested. So this will be more apparent when we look at the daily time frame, when we go over the risk ranges for the week ahead, but still has some downside, but the bounce possibility is nearing a good level. Just be patient with it. The MACD is crossing over, pushing back down. RSI is continuing its downtrend. It's not below 50 quite yet. So we have to keep an eye on these things as well. Monthly chart of the QQQs. All these time frames are the same, guys, 15 years going back. Now, we've talked a little bit about this head and shoulders possibility. Remember where we had a left shoulder, a head, and a potential right shoulder here. I'm a little bit skeptical of that, but it's still in the back of my head as a possibility. So I'm really looking at this confluence of support. Could be anywhere between 297 and 290, lining up to this upper broadening wedge. So I didn't note this. This is an interesting index. And obviously, when there's a lot of money out there, a lot of speculation, a lot of hype over growth stocks, the tech stocks tend to go up exponentially more than value stocks, banks, things like that. So we've got this broadening wedge, right? That's similar to the S&P, but the difference here is we almost had a breakout and another broadening wedge form. So again, speculation, lots of money flowing into growth stocks. This doesn't surprise me. This is generally why tech stocks get hammered the most in a market correction. Okay, volume here, nothing to be too concerned about. This candle is a bearish engulfing. Doesn't look very pretty. MACD still crossed over, rolling down, and the RSI is now below 50. So there are some things here to be a little concerned about. Again, I'm still a little skeptical of this head and shoulders, but possibly what could happen here, and again, this will be more apparent on the daily chart. If we get back down to this trend line, this should present a nice confluence of support. You've got support here from the prior breakout, and you've got this trend line that hasn't been back tested yet. So the possibility of maybe coming down here, and as I've noted here, the head and shoulders will be confirmed if 320, which is this trend line area here, confirms as resistance. So if we get here, we bounce back up to 320, and then we break back below, this head and shoulders pattern to me is confirmed. And the measured move is down to, this should be not 320. This should be 220. So anyways, yeah, 220. But yeah, so we got to kind of wait and see how this plays out. Do we get a drop down here and then we get a bounce back up to 320 before we continue on down? Or, as I've mentioned before in the previous video, do we bounce down here and we get a bounce back up to this prior level here, which is around, I think, 337, somewhere in that range. So that would present the possibility of a bigger head and shoulders. And what I mean by that is, if this is your right shoulder that comes up and retests that level, now you've got a larger topping pattern forming here. So that's why I'm saying I'm skeptical of this first one that we talked about. Maybe this is another just simple ABC pattern to come down and retest that trend line before we get a decent bounce. Now it'd be prudent to cover the Russell 2000 or the IWM. Again, very similar patterns. You can see this broadening wedge. Same type of scenario, resistance all the way running up here, broke out. The difference being this one already failed to hold here, right? It tried to hold up through this whole scenario. I mean, you've got how many, over a year again, we've talked about of this fatigue breakout up top here before it broke back down. So again, what I'm kind of looking at, and maybe because we have an ABC pattern in the spiders potentially and the IWM, maybe the Qs leads me to believe it's more of an ABC pattern. But again, your A is your first down leg, your B is back up, and your C is equivalent to A, which again lines up nicely with this confluence of support, this previous high here. You do have the possibility of maybe coming down into this lower range. So again, depending on how big the selling goes or how violent it is, they can overshoot these levels regularly. So if, for example, you're looking to swing trade something like that, I wouldn't necessarily go all in at this level. I would do a fraction of what you're comfortable with as a full position. So maybe you do a percentage here. Maybe you start with 30%. Maybe you start with 50%. Whatever you're comfortable with. I can't tell you what to do. I'm not a financial advisor. But these are just potential ways to play this out. So if you start with 50% here at this level, then maybe if it drops down here, maybe you add the other 50 or you add another 25 or something like that. just giving you some ideas on how to potentially play something out like this. Now, I'm not going to go into a whole bunch of different sectors, but I wanted to touch base on two very important ones. And to me, there are a lot of different important sectors. I'm not going to say they're not, but one big one I've talked about is the banks. So this is the XLF monthly chart. Again, similar pattern. And there is possibility up here of a head and shoulders, again, that I'm skeptical of. It's more prevalent on the daily, shorter time frames. But again, this would be your left shoulder, head, and right shoulder. And we have to be open to these levels. So this previous high here could be support at 30.73. Goes back all the way even to the financial crisis. And if you count this as a actual head and shoulders, your measured move goes down to around this 29.32 level. So being open-minded to this, if you were short, I would look to cover around this level, potentially if we get down there at some point. But we have to be mindful, if this does play out, I would expect this to be resistance. So we could get some reprieve back up to retest this level. We'll have to see what that is on the daily chart. I can't confirm at this point. Actually, no. Confirm 35.63. So that would be this level right here that I'm pointing out. So if that holds as resistance, then this pattern is confirmed. If it continues back down, I should say. So gives you some levels on the XLF and the bank sectors to watch. The last one on a monthly time frame I wanted to focus on is the SMH. This is the Semiconductor ETF. Again, very similar pattern to the QQQs. So you've got a normal ranged wedge playing out here, or broadening wedge. But then upon the breakout here back in 2016, 2017, you can see it kind of formed another one here. So again, it goes back to the speculation, the exuberance, the growth stocks, everybody pumping money into tech because of the momentum they get to the upside. But that momentum can be a detriment on the downside when people start to sell off. I'm not calling any patterns or anything here, but you just have to be very mindful of what's been going on here. If these continue to drop, it will take the tech sector down. A lot of the tech industry, components, cars, everything rely on semiconductors, as we all know, for chips and things like that. So further down the line in data, we should definitely keep an eye on how the auto industry is doing, Tesla, Ford, GM, the typical car makers, and what demand is like. From a technical side, okay volume here. MACD's crossing over, pushing down. RSI is right around 50. So I don't see any major support quite yet. But again, I'm looking for a bounce on the indices. So this will likely play a part in that. And we do have AMD earnings this week, which I will briefly go over later on. So that could be a factor in how these semiconductors play out here in the next week or the next few weeks. Okay, moving forward, let's look at the risk ranges for the week ahead, since we've covered all of the larger time frame monthly stuff. The first one we'll look at is a SPY. Now, one thing to note with all of these, because the VIX is so much higher, the volatility has expanded. The ranges of the indices of stocks generally have gotten much wider. So what happens is the premiums, the implied volatility on the options move up, and essentially these ranges get much wider as well. So SPY is pricing in a $16.83 move. That takes us up to around this 429, coincidentally. Nice previous resistance areas. And the lower side takes us down to around 395-ish. So nicely and coincidentally lines up with these previous resistances here and the support that we talked about. This is this larger time frame trend line I was talking about. So you've got a nice confluence of support down here. And you can see there's a gap here, We've got another gap here. So there's kind of some unfinished business in this area. That's why I'm really liking the prospect of a long position down in here somewhere, guys. Again, because of the way the market is working in volatility, there's always the potential that it comes down to this level nicely and bounces, or I've seen them flush below this, who knows to what extent, and then recover this at the end of the day. So you get this long bottoming type of capitulation candle. So you might get a big body and a big wick on it. So we've seen that before too. You kind of got one here. So just keep that in mind. When you get these capitulation bottoms, you get longs just giving up, more shorts are piling in, and then you have nothing but buyers left to run it higher. That's generally the dynamic of those types of bottoms. So keep this in mind. Every week we start in the middle, so I like to wait a day or two before we kind of see how this is going to play out. The QQQs, daily or weekly risk range, Let's just note this is that trend line I was talking about with the head and shoulders. I should change this color so it's a little bit more obvious, huh? Let's go yellow so you can see this potential neckline here. Your head and shoulders pattern. And you've got a confluence of support down near this 297 range, previous resistance turned support. And coincidentally, your risk range of the low side is around 298. Beautiful confluence here, right? So you've got a nice potential risk reward long here. Again, could they drop this down to 290 to touch this trend line? These trend lines aren't set in stone, so there's always some wiggle room here to be aware of. The upper risk range would take us up to around 328. IWM. Pricing in an $8.50 move. Takes you up to around 193 or down to around 176. And there's a lot of kind of noise in this area. So it's really hard to say where you're going to get any clear support. I've got some ranges here that I noted on the monthly time frame. So that's why I kind of put this as 165, 173. Somewhere in this range you could get some support. I'm not saying we get down there this week, because as we saw last week, the Russell got a nice bounce off of its lower risk range twice. So this may take some time to play out down to this level, but you can see even in here you've got some gaps that need to be filled, especially in this range. So there is potential for there to be some prior resistance here, turn support. Maybe we come down here and bounce back up to retest this level as resistance before continuing on down. So be open-minded to that. This one will be a decent trade, just depending on your style of trade, if you're a long trader, if you're a short trader. And in this market, you got to be quick to take profits because they can be sucked out real quick. Moving ahead to earnings, we got another busy week ahead of us. Looks like a little bit more hospitality, leisure, travel type of stocks with a little bit of consumer purchasing side. So on the leisure, Expedia, Airbnb, Lyft, Caesar Entertainment. There's some Marriott in there. I didn't highlight those. I only highlight the ones that I'm more interested in. Consumer side, Shopify, Etsy, Mercado Libre, DoorDash, Lyft. These will all be interesting ones to see for the week. I'll go over a couple of these, the ones that I'm kind of interested here, and we'll look at a couple charts. Let's look at AMD. On a larger time frame, I just wanted you guys to see where this stock has been historically and where it is currently. So, over the last 30 some odd years, it's traded in this range of a dollar-ish up to around 42. And you can see over the last, four or 5 years, it's just been on this tear higher. So 2018, it was a $9 stock. It ran all the way up to 164. So again, kind of another broadening wedge playing out here. This is a weekly time frame. Let's look at the daily, the risk ranges here. Let's go 2 year so you can have a better picture. So pricing in a $9.60 move takes us back up to around 95.07 and 75.85, somewhere in that range. So it's interesting to note how these ranges coincidentally line up with, prior resistances, prior supports. So again, it offers you an opportunity to trade these. If for example, it gaps up on earnings, maybe you get a short opportunity. If it gaps down, maybe it gives you a long opportunity. But depending on how earnings are, you have to be aware of those additional deviations, right? So if, for example, it gaps down below this range, you have to pay attention to that second deviation, another 960 below this level. Because again, that can create more selling pressure and vice versa. If it gaps up above this upper one and it can hold it, it can definitely create more upside movement too. So you have to be aware of that on both sides. But under normal circumstances, again, 68% of the time, we're closing right within this range. Let's take a peek at Fortinet. Pricing in a $43.06 move takes you back up to 332 or all the way down to 245. So you've got a big range here. This could be either a big mover on earnings or it could be a big dud. This will be very interesting. Again, kind of brings you back up to that prior resistance. But there is, and again, I hate to focus on these topping patterns, but this could potentially be a large distribution phase, right? You've had a big run up from 100, 200%, 300% gains on this. So you got to be very careful trying to go long these types of stocks. I don't know enough about the company itself, but just from a technical standpoint. Shopify. This one's interesting to me. Pricing in a $65.93 move. And why I say it's interesting is because you've got a series of lower lows here, and your MACD has a series of higher highs. Your RSI has a series of higher highs. So you've got some potential bullish divergences here. Is this one have some squeeze potential? I mean, even you've got some decent volume here. This was, well, it was still down on Friday, but it was holding relatively well. How earnings could play out will make this interesting. I wouldn't say I like it long right in the middle of this range, but maybe you get a spike down in after hours and you get a recover back up, or maybe it gaps down and you kind of see how it plays out in the morning down at this lower level. So these levels are, let's zoom in here a little bit. Kind of hard to see with that larger time there. 514, coincidentally, you've got some previous resistance or support that could potentially turn resistance, and down to around 360. Let's look at DoorDash. Pricing in a $15.44 move. Fundamentally, I don't know how this one can last, especially if the consumer is getting squeezed with inflation on essential items. I think things like DoorDash that are so expensive on top of the costs of fuel that have gone up dramatically, this one's going to be a tough one to beat, in my opinion. You do have maybe some trendline support here. The challenge with that is if earnings are bad and this thing does drop below this level here, which is 65 on the low side, 98 on the upside. I mean, if this gets down here, you're going to have some potential selling pressure happening. So I don't know. I wouldn't like this one long at all, because again, if this does play out in some form or fashion like this again could be an ugly topping pattern here. I didn't mean to do that. I mean, I just don't like like the look of this. And again, I don't fundamentally like this at all either. I think that's enough charts for the evening and day, depending on when you're watching this. The last thing we have are the economic reports coming up. So the ones I'm interested in: Monday, ISM manufacturing, construction spending. Tuesday, job openings, factory orders, motor vehicle sales. That'll be a good one. Wednesday, ISM service manufacturing. And the big one is going to be the FOMC statement and the Fed Chair Jerome Powell news conference. On Thursday, Friday, obviously, we've got a non-farm payrolls because we are in the beginning of May. So that will be an important indicator, as well as consumer credit in the afternoon. That's all I have for you guys. As always, I appreciate you watching, listening, giving the time to this content. I've put a lot of effort into it. I've probably spent more time on it than I should have, but I've enjoyed learning something new. And again, this is accountability for myself as well, and learning new things in the technical world. So hope you learned something from it. Have a great week. If you got any questions, ideas, comments, input, feedback, I'm more than open to listening. Have a great week, guys. Till next time.